This is Trade Alive with IUX, where markets come alive and trading gets real. Let's go live.
This podcast is brought to you by IUX Trading Platform, elevating your trading experience.
Welcome, listeners, to another enriching episode of the IUX podcast, a part of Trade Alive brought to you by IUX Education. Here, we explore the fascinating dynamics of market observation and personal development. Before we begin our charting analysis today, please note this important regulatory warning. Trading Forex and contracts for difference, or CFDs, involves a high level of risk and is speculative in nature. Trading with leverage can result in losing your money rapidly. In fact, 76% of retail investor accounts lose money when trading CFDs with this provider. You should carefully consider whether you understand how CFDs work, whether you can afford the high risk of losing your money, and whether leverage trading matches your financial objectives. Please note that the discussions in this episode are for general educational and informational purposes only and do not constitute personalized investment, financial, or direct trading advice. Now, let's return to today's episode, where we help you explore the lives, lessons, and legacies of accomplished historical traders. Today is a comprehensive exploration of a truly fascinating subject within the realm of financial market analysis. We are embarking on a detailed journey that examines the structural evolution of how individuals observe, interpret, and interact with market data. The evolution of financial market analysis continuously moves toward greater efficiency and precision. For many market observers, the journey begins with manual analysis, reading charts, applying indicators, and executing decisions based on real-time observation. When you first begin studying the vast landscapes of global markets, the traditional approach involves dedicating countless hours to watching price movements unfold on the screen. This manual observation builds a foundational understanding of market mechanics. You learn to visually identify trends, recognize the ebb and flow of volume, and appreciate the rhythm of structural price action. However, while this manual process is incredibly valuable for building intuition and structural awareness, it often introduces variables such as fatigue and subjective interpretation. Human beings possess incredible analytical capabilities, but we also require rest, and our perceptions can occasionally be swayed by monetary enthusiasm or hesitation. This realization brings us to a highly relevant concept in modern market study, the transition from manual execution to systematic automation, widely known as algorithmic trading. By shifting our perspective, we open up entirely new dimensions of analytical capability. This approach utilizes computer programs to follow a defined set of instructions, an algorithm based on timing, price, and quantity, operating at a speed and frequency that manual observation simply cannot match. Imagine being able to observe multiple assets simultaneously, with absolute consistency, never missing a predefined condition simply because you stepped away from your screen. Systematizing your logic means translating abstract analytical concepts into concrete, rule-based parameters and quantitative models. A systematic approach requires defining exact conditions for market entry, position management, and exit strategies based purely on quantifiable data. The primary goal of this transition is to maintain analytical objectivity by removing human emotions and psychological biases from the decision-making process. By predefining the rules of engagement, such as trend-following conditions or mean revision principles, observers can maintain systematic execution and evaluate their strategies through rigorous historical backtesting. This allows market participants to base their ongoing studies on structural market facts rather than monetary institutions. Historically, developing automated systems required a deep understanding of complex programming languages. Decades ago, if you wanted to test a systematic idea, you had to be exceptionally proficient in writing hundreds of lines of complex code, or you had to collaborate closely with dedicated software engineers. This technical requirement often created a barrier to entry for individuals focused purely on market analysis rather than software engineering. It kept the remarkable benefits of automated observations confined to a highly specialized group. However, we are living in a remarkable era of technological innovation. Advancements in financial technology have democratized this process beautifully. Today, exploring how to automate a trading strategy without coding has become an accessible educational pursuit. Understanding this process empowers individuals to focus on refining their analytical logic and structural market frameworks, leaving the mechanical execution to automated tools. You are now able to act as the architect of your logic, designing the blueprints of your strategy, while modern software handles the heavy lifting of translation execution. The objective of learning this system is strictly educational, providing a methodological way to study market behavior, organize data, and test hypotheses in a highly structured environment. By removing the barrier of complex coding, anyone with a dedicated mindset can translate their observational theories into testable, systematic frameworks. This evolution encourages a highly disciplined, objective, and data-driven approach to studying the financial markets, paving the way for continuous learning and structural market awareness. To fully understand the mechanics of automated logic, it is essential to explore the step-by-step process of system creation. We must dive deeply into how theoretical market concepts are transformed into systematic architecture. The core of any systematic approach relies on defining an algorithm. Fundamentally, an algorithm is a specific set of unambiguous instructions or rules designed to accomplish a task. In the context of financial markets, this involves creating pre-programmed trading instructions that account for core variables such as time, price, and volume. The foundation of this architecture relies on logical if-then statements. This is the universal language of conditional logic. For instance, if the price crosses a specific moving average and the volume is above a certain threshold, then a specific action is executed. Let us expand on this with a more comprehensive example. Imagine you're observing the relationship between short-term momentum and long-term trend direction. You might define a condition stating, if the 14-period relative strength index crosses above the 50 level and the current closing price is positioned above the 200-period exponential moving average and the current time is within the action London market session, then a specific observational marker is placed or a simulated execution is generated. Structuring these conditions requires profound clarity and a deep understanding of the structural indicators one chooses to employ. You must define every single parameter with an absolute precision. For individuals seeking to understand how to automate a trading strategy without coding, the modern financial technology landscape offers visual builders, or specialized platforms designed for non-programmers. These are highly functional tools, specially designed for non-programmers. These platforms function similarly to puzzle pieces, allowing users to visually drag and drop specific conditions, indicators, and execution commands onto a canvas. You are essentially building a flowchart of your analytical mind. Let us categorize the primary components you will interact with when using these visual builders. Condition blocks. These define the broader market environment. They act as the overarching filters that must be aligned before any further logic is considered. You might use condition blocks to specify the time of day, ensuring your system only operates during highly liquid market sessions. You could use them to select specific asset classes or to define overarching trend directions based on higher time frames, such as requiring a daily moving average to be sloping upwards before looking for smaller time frame opportunities. These represent the exact moment of an execution should occur. Once the broader environment outlined by the condition blocks is verified, the system waits patiently for the trigger block to activate. This could be a specific candlestick closing above a defined structural zone, the crossover of two momentum oscillators, or a price action pattern completing its formation. The trigger is the precise catalyst for action. Management blocks. These dictate how a position is handled once active. A true systematic approach emphasizes rigorous risk management, utilizing these blocks to enforce fixed stop losses, configure time-based exits, and automate position sizing based on a strict percentage of account equity. For example, a management block can be designed to dynamically move a protective threshold to a break-even point once a certain initial distance is reached, or to scale out a portion of the position to secure a realized outcome while allowing the remainder to continue observing the trend. By utilizing these visual interfaces, the software automatically translates the user's mapped logic into the required programming syntax, such as MQL4, MQL5, or Python, in the background. This technology allows analysts to build sophisticated systems without being software engineers. You simply arrange the logical blocks, connect them visually, and the platform generates the complex code seamlessly. Furthermore, delegating these tasks to a computer removes manual execution delays and human hesitation, ensuring that the predefined instructions are followed with rule-based discipline and speed. A crucial component of systematic logic is the concept of historical data observation, commonly known as backtesting. Systematic analysis thrives on the ability to process and manage large datasets efficiently. Once the logical framework is automated, it can be applied to years of historical market data within seconds. Imagine the educational value of this capability. Instead of manually scrolling through months of charts and writing down observations one by one, the automated systems compiles thousands of data points instantly. This process provides a wealth of empirical data, illustrating how the specific logic performed across various market cycles. You can observe the frequency of occurrences, the average duration of optimal conditions, and the historical variations in outcomes. Backtesting fosters an objective analytical mindset. It allows individuals to observe the statistical probabilities of their logic, highlighting conditions where the strategy performs optimally, and environments where the logic may require recalibration. It provides a mirror reflecting the true historical characteristics of your observational theories. Furthermore, observers utilize forward testing in simulated environments commonly referred to as demo accounts. They involve running the automated logic in real time with virtual data to observe its interaction with live market spreads, execution latency, and current macroeconomic volatility. While backtesting provides historical context, forward testing verifies how the logic processes the immediate breathing market. Combining historical backtesting with real-time forward testing builds a comprehensive data-driven understanding of the strategy's mechanics. You get to watch your logic operate under current conditions, gathering entirely new datasets for ongoing study. Furthermore, because the simulated outcomes do not represent actual execution with live capital, they may under or overcompensate for real-world market constraints, such as execution latency, insufficient liquidity, and dynamically widening bid-ask spreads. The goal is continuous refinement and a deeper understanding of market structure. As we draw this detailed exploration to a close, let us reflect on the profound concepts we have discussed today. The transition from manual observation to systematic automation, widely known as algorithmic trading, represents a structural maturation in financial market analysis. It is a shift from purely qualitative interpretation to highly quantitative objective measurement. By defining precise, rule-based algorithms through logical if-then statements based on time, price, and volume, observers can eliminate psychological biases and execute strategies with objective discipline. We have seen how defining the environment, the specific triggers, and the methodological management parameters creates a comprehensive framework. Today, the advent of visual creation platforms has profoundly democratized this process, demonstrating how to automate a trading strategy without coding by allowing users to structure condition, trigger, and management blocks intuitively. This evolution removes the technical barriers that once kept many dedicated students of the market from exploring systematic analysis. This technological accessibility enables rigorous historical backtesting and real-time forward testing to gather objective empirical data. Through these tools, you are empowered to process vast amounts of historical information, evaluate the statistical characteristics of your logic, and continuously refine your approach based on factual evidence rather than subjective feeling. However, it is vital to approach these tools with an educational mindset. Automation is an extension of human logic, not a replacement for comprehensive market understanding or a guarantee of future outcomes. The machine only does exactly what you instruct it to do. Therefore, the quality of the system is entirely dependent on the quality of your foundational market knowledge. Consequently, the observer's role shifts from manual execution to consistent system management and periodic recalibration. You become the overseer, the designer, and the data analyst rather than the manual operator reacting to every tick on the chart. Ultimately, systematizing your logic transforms abstract theories into quantifiable frameworks, empowering individuals to navigate the vast dynamics of global financial markets with enhanced clarity, factual awareness, and a disciplined commitment to continuous learning. This ongoing journey of organizing data and testing hypotheses is one of the most rewarding educational experiences available in modern market study. I would love to hear your perspectives on this analytical evolution. What specific logical conditions or market indicators are you most interested in translating into a systematic framework? Please share your thoughts and structural ideas in the comments below, so we can continue this fascinating discussion and learn from each other's analytical journeys. If you found this educational episode helpful, feel free to like, subscribe, follow, and share it with others on their trading education journey. As a final reminder, trading of financial products involves significant capital risk. 76% of retail investor accounts lose money when trading CFDs with IUX markets. Please ensure you fully understand the risk associated with leverage and margin requirements before engaging in financial markets. Past performance and backtested results are not reliable indicators of future market outcomes. Keep observing, stay dedicated to your data, and I look forward to exploring more concepts with you in the next episode. Thank you for listening. Goodbye.
You've been listening to Trade Alive with IUX. Ready to put these insights into action? IUX is here to power your next winning trade.